You sold your home last year and assumed the principal residence exemption was automatic. Or maybe you rented out a basement suite for a couple of years, or moved out temporarily for work. You filed your taxes, didn't hear anything, and figured you were fine. But here's what most Canadians near retirement don't realize. The CRA has been quietly building a system that matches your property records, your tax return, and third-party data, all without telling you. And if your numbers don't line up, you don't get a warning. You get a reassessment, sometimes years after the fact. I used to think the principal residence exemption was a slam dunk. You own the home, you live in it, you sell it, the gain is tax-free. Then I learned about the change in use rules, and I understood why so many people get caught off guard. It's not that they're doing anything dishonest. The rules are just more complicated than the exemption sounds. We're talking about your principal residence, potentially hundreds of thousands of dollars of tax-free gain that could be at risk if you don't know the one election that protects it. Today, I'm walking through the 5 CRA audit triggers that are catching Canadians off guard right now. Some of these are obvious, some aren't, and one of them is almost certainly something you've never heard of. If you're a Canadian homeowner near retirement, this is exactly the kind of thing you need to know before the CRA finds it first. Let's start with the trigger that hits more near retirees than any other: the change in use trap on your own home. Most Canadians think the principal residence exemption works like a blanket. If you live in the home, the whole gain is tax-free when you sell. And that's roughly true, until you change how you use the property. Here's the mechanism. When you convert part of your home from personal use to rental use, even renting out a basement suite for 1 year, the CRA treats that as a deemed disposition, not an actual sale, but a deemed sale at fair market value for the portion you rented out. That triggers a capital gain, even though no money changed hands. And if you didn't know to file a specific election when the change happened, you can't go back and fix it after the fact. The election is under subsection 45(2) of the Income Tax Act. Most Canadians have never heard of it. What it does is allow you to treat your home as still your principal residence for up to 4 years after a change in use. That keeps the exemption intact. But, and this is critical, you have to file a letter with your tax return for the year the change actually happened. You don't get a second chance to file it retroactively in most cases. Let's put a number to this so it's concrete. Say you bought your home for $400,000 and it's now worth $600,000. You rented out 30% of the home, a basement suite, for 2 years. Without the 45(2) election, the CRA deems you sold 30% of the home at fair market value the moment the rental started. That's 30% of a $200,000 gain, which is $60,000. Under the 2026 capital gains inclusion rules, you'd include 50% of that, $30,000, as taxable income. At a 30% marginal rate, you'd owe $9,000 in tax, plus potential interest and penalties if it comes out in an audit. $9,000 on income you never actually received. That's the mechanism at work. Now, some people did file the election years ago and have forgotten about it. That's fine. The protection is still there as long as the paperwork exists. But if you rented part of your home, moved out for a year for work, or even used a room exclusively for a business and claimed home office expenses, those are all events that can trigger the change in use rules. The CRA is cross-referencing property records, rental income declarations, and home office deductions. If you claimed a home office deduction in 1 year and are now reporting a principal residence exemption, that's a flag their system can catch. A lot of people in their 50s and 60s have been in their homes for 20 or 30 years. There may have been a period, a rental, a job transfer, an adult child who paid rent that they've long since forgotten about. The CRA hasn't forgotten because the data is still there. Knowing about the 45(2) election doesn't solve everything, but it does tell you where to look and what to ask your accountant about before you sell. That's the starting point. The next trigger hits people who are trying to be smart with their TFSA and end up crossing a line they didn't know existed. The TFSA gets described as a freedom account. No tax on growth, no tax on withdrawals, and for most people who use it the way it was designed, long-term holding of index funds, GICs, dividend stocks, that's exactly what it is. But if you're trading actively inside your TFSA, you may have a problem you don't know about yet. The CRA draws a line between passive investing and carrying on a business. Passive investing means you're buying and holding, occasionally rebalancing, maybe selling when you need the money. Carrying on a business means you're generating income through frequent transactions, using leverage, or trading options. The difference matters because capital gains inside a TFSA are tax-free, but business income is not, even inside the account. The CRA's Interpretation Bulletin IT 479R lays out the factors they consider. The frequency of transactions, how quickly positions are turned over, whether you're using leverage, whether you hold yourself out as someone with special knowledge of the market. There's no single hard threshold, but fewer than 10 trades a month with no pattern of short-term flipping is generally considered passive investing. Much beyond that, especially with options or leveraged positions, and the CRA starts to see a business. What does reclassification look like? Say you made $20,000 in gains trading options inside your TFSA last year. You assumed it was all tax-free. The CRA audits and reclassifies those gains as business income. At a 30% marginal rate, you'd owe $6,000 in tax, plus interest for late payment, plus potential penalties depending on how the return was filed. I remember hearing about a case, someone making 15 trades a month, selling covered calls, rotating between positions every few weeks. He thought he was being disciplined and smart. The CRA saw a pattern that looked like a business. The TFSA protection didn't apply. It's completely normal to want to use your TFSA actively, especially as you approach retirement and you're paying closer attention to your money. The frustration is that the rules don't match that instinct. The account was built for long-term saving, not active trading, and the CRA is watching for the gap between what the account is supposed to do and what some people are actually doing inside it. If you're making a lot of trades in your TFSA, it's worth a conversation with a tax professional before the CRA has that conversation for you. From your TFSA, let's move to something that catches people who own property or investments outside Canada, sometimes without even realizing they're offside. If you own foreign property and the threshold is lower than most people think, the CRA requires you to disclose it every year on Form T1135, not just once, every single year that you hold it. The threshold is $100,000 CAD in cost at any point during the tax year. That includes a U.S. brokerage account you opened at a previous employer, a vacation condo in Florida, shares in a foreign company, or even a foreign bank account with a significant balance. If the total cost of all your foreign property crossed $100,000 at any time in the year, T1135 is required. What's the penalty for missing it? $25 a day for a late filing, up to $2,500 per year. If the CRA considers it gross negligence, meaning they believe you knew and didn't bother, that goes up to $12,000 per year. And those penalties can apply for every year you missed the filing, not just the most recent one. The part that catches people off guard is how much information the CRA already has. Canada participates in the Common Reporting Standard, an international agreement that covers more than 40 countries. That means foreign banks and brokerage firms are reporting your account information directly to the CRA. If you have a U.S. brokerage account and you haven't filed T1135, there's a reasonable chance the CRA already knows about it. A lot of people in their late 50s and early 60s have financial accounts from a period in their life they've mostly moved on from. A stint working in the U.S., an investment account opened years ago that they never closed, an inheritance that included foreign assets. The fact that it feels old doesn't make it invisible to the CRA's reporting systems. If you have foreign property over the $100,000 threshold, make sure T1135 is on your accountant's checklist. It's a disclosure form, not a complex calculation. The issue is simply that people don't know it exists until they receive a letter asking about it. That brings us to trigger 4, which is new enough that many people haven't adjusted yet. Crypto. A lot of Canadians bought Bitcoin or Ethereum during the 2020 and 2021 run-up. Some sold, some held, and some made trades between coins and mostly forgot about it. That last group has a problem now. As of January 1st, 2026, Canada's Crypto Asset Reporting Framework, the CRA's version of what the OECD has been rolling out globally, requires Canadian crypto platforms to collect detailed transaction data. That data goes to the CRA starting in 2027, covering all of 2026's transactions. Every trade, every exchange, every transfer to an unhosted wallet. Here's why this matters. When you trade one cryptocurrency for another, say you traded Bitcoin for Ethereum in 2026, that is a taxable disposition. It doesn't matter that no dollars changed hands. The CRA treats it the same as selling an investment. If you made a gain, it needs to be reported. If you didn't report it, the CRA will see the transaction in 2027 when the platform data comes in. For people near retirement who bought crypto a few years ago, held through the volatility, and made some trades along the way, this is worth reviewing before filing your 2026 return. A gain you forgot about can become a reassessment you weren't expecting. The mechanics aren't complicated. Crypto is a capital property. Each disposition creates either a capital gain or a capital loss. The challenge has always been record keeping, knowing your adjusted cost base for each position, tracking every trade. The new reporting framework means the CRA will be matching what they receive from platforms against what you reported. Gaps will show up. If you have crypto holdings you haven't thought about in a while, this is the year to go through the transaction history and make sure your records are complete. The 5th trigger is different from all the others. It doesn't involve a specific account type or asset class. It's about something the CRA calls a lifestyle mismatch, and it catches people who think they're too small or too simple to be noticed. The CRA doesn't just look at your tax return in isolation. They compare it to everything else they can see. Your property purchases, your vehicles, your travel patterns, public records. When what you report doesn't match what your life looks like, that's a flag. Here's a realistic scenario. You're retired, reporting $40,000 in pension income. You bought a new car, took a trip to Europe, and own a cottage. That spending pattern is inconsistent with $40,000 in income, even in retirement. The CRA's systems are built to catch exactly that mismatch. They don't need to prove anything up front. A mismatch is enough to trigger a review. The issue isn't the cottage or the car. The issue is whether there are income sources that weren't reported, freelance consulting work, cash jobs, rental income from a property, side work since retirement. A lot of people in their late 50s and early 60s are still working in some capacity, maybe informally, and they underestimate how visible that income becomes when it doesn't show up on a return. Unreported side income is one of the most common triggers for individual audits. It's not just about people trying to hide something. Sometimes it's simpler than that. Someone helped a friend renovate a kitchen, got paid in cash, didn't think much of it. Or they did some contract consulting after retiring from their main job and assumed it wasn't enough to matter. The CRA's view is that every dollar of income is reportable income. I don't know the specifics of your situation, but if something feels off in your return, If there's income you received that isn't on a slip, or expenses you claimed that don't have clean documentation, it's worth going back through it before the CRA does. Not out of fear, just as a practical step. Those are the 5 triggers. The question now is what you actually do about them. Knowing the 5 triggers is the first step. Here are 3 things you can do right now. First, report every property sale, even if you believe the gain is fully exempt. Since 2016, the CRA requires you to report principal residence sales on Schedule 3 of your tax return. If you miss that step, the CRA can deny the exemption entirely, not because the house doesn't qualify, but because you didn't follow the reporting process. Second, keep a record of any change in how you use your property. If you ever rented part of your home, moved out for a period, or claimed a home office deduction, document the dates and talk to your accountant about whether a 45-2 election should have been filed. The earlier you know, the more options you have. Third, review your TFSA trading history. If you're making more than roughly 10 trades a month, especially in options, consider whether some of that activity should move to a non-registered account instead. The biggest barrier is usually putting this off. You tell yourself you'll deal with it next year, but the CRA's data doesn't wait. Set a reminder for next April to go through your T1135 filing, your TFSA activity, and your property records. That review takes maybe an afternoon, and it's worth doing. The 5 triggers we covered today are the Principal Residence Change in Use Trap, TFS, a day trading reclassification, foreign property and the T1135 filing requirement, crypto transactions under the new 2026 reporting framework, and lifestyle mismatches from unreported income. The common thread running through all of them is that the CRA is working from data you don't always know they have. You don't need to be afraid of the CRA. You need to be prepared. That's what this channel is about, giving you clear, practical information about how the system works so you can make better decisions going into retirement. If this video helped, please give it a like and share it with a friend who owns a home or has ever traded in their TFSA. And if you want to catch more videos like this one, hit subscribe. I'll see you in the next one.